Hi everyone. Today we're going to be looking at Chapter 13, which is Accounting for Corporations. It's kind of a continuation on from Chapter 12. Chapter 12 we focus on partnerships. Now we're going to look at another business formation, which is corporations. When we look at them, we're going to be looking at the different characteristics of corporations and how they can be organized. So let's start in the beginning. So they can be a privately held corporation or a publicly held corporation. If it's a privately held corporation, that means that they are not selling their stock out in the public. It's usually just a few stockholders, but it's controlled and not offered to just anyone. With a publicly held corporation, that means that they're offering their stock out there in the public, and there could be thousands of shareholders or stockholders. The public sale is usually when we're talking about issuing stock or trading on some kind of an organized stock market. Now, when we look at that, one thing that we need to look at is that a corporation isn't its own entity. It has a separate existence from the owners, so the owners are the stockholders, but the entity itself is separate from those stockholders. They have a stock share, but one share doesn't own the entire company. The other thing is that there are specific rights and privileges that come along with a corporation, and we're going to look at some of those characteristics and those rights in the next slide. All right, so they have it broken down into advantages and disadvantages. So let's talk about the first couple of advantages. The first one is a separate legal entity. So that means that it's its own separate entity. It has the same rights, duties, and responsibilities that a person would have. It can take action through its agents, which would be like the officers or the managers, but it's its own legal entity. The next one is the limited liability of stockholders. So this is really important. When we look at that, we're talking about the amount that you invest in a company is the most that you can lose. So the stockholders are not liable for what the corporation does or the debt that the corporation creates. So with limited liability means that the liability to pay a debt or for damages or malpractice, something like that, is going to be limited to a stockholder. So if you bought $1,000 in stock, shares, that's the most you can lose. You may lose the $1,000 if that company goes under, but they can't come after your personal assets. Remember when we talked about sole proprietorships and partnerships, you were at risk of being responsible for any debts that were created by that company. So corporations a little bit different. The next thing is transferable ownership rights. So the shares are the ownership. So they're easily exchanged from one stockholder to another, and it doesn't typically matter who owns the shares of stock as far as how the company is going to operate on a day-to-day basis. Depending on how many shares there could be a change in control if someone has a majority of shares and they are then considered to be majority owners. They might have more of a say, but the rights as far as stock ownership can be transferred very easily. The next one is continuous life. So we talked before about with a sole proprietorship or with a partnership, the lives end with that ownership. So if someone were to have a sole proprietorship and that person passed away, that business as it is done. It could be sold to someone else or it could be transferred to someone else, but then that new owner would be the new owner of that company and would have that life of the company. With a corporation, its life continues on indefinite because it's not tied to the lives of its owners. It's tied to that stock, which again can change ownership pretty easily. The next one is lack of mutual agency for stockholders. So what this means when we're thinking about corporations, they're going through and creating contracts and making decisions based off of their agents or their officers and managers. And since the stockholders are often not the officers and managers, they don't have the power to bind that corporation to the contracts. So that's referred to as a lack of mutual agency. So that's a good thing because we don't want the stockholders to be able to decide something for a company when they're not the ones that are running the company on a day-to-day basis. The next one is the ease of capital accumulation. So with a corporation, it's easy to issue stock, which means you can raise money and accumulate capital pretty easily. So buying stock is a good way that people can invest in a company, and it's an attractive way because stockholders are not liable for their corporation debts or what the corporation does that could get them in trouble. There is the ease of transferability, and the life goes on forever. So being able to offer those type of investments allows you to accumulate that capital pretty easily. All right, the next part looks at disadvantages. So some of the disadvantages are going to be governmental regulation, and that depends on the industry. So if it's a publicly held corporation, it's required to report to the SEC, and depending on what field it's in, it may be subject to report to other governmental regulations, such as if you were looking at the insurance or the banking industry, they have federal and state laws that they're required to follow, so that adds a little more of governmental regulation into their fields. The other part is corporate taxation. And when we talk about that, we're talking about the corporation themselves. So what are they paying in taxes? Taxes and corporation are a little bit different. So the corporation, remember, it's its own entity. So it's paying taxes as that entity. But if the company or corporation pays out dividends, those dividends are paid out to stockholders. Those stockholders have to pay taxes on those dividends. So what happens is that income was taxed in the corporation, and then it's taxed again as a dividend. So we call that double taxation. So that's why it's a disadvantage, because the same income is technically being taxed 2 times. It's taxed at the corporate level, and then it's taxed at the individual level of those who are receiving those dividends. All right, when we look at how is a company ran and why is it important, corporate governance is one of the most important things that we see looked at by regulators at this point, because it's telling us how did the company direct and control their processes. So there's typically a order of command. So when we look at this, we can see that the stockholders are at the top of it. The board of directors reports that information that the stockholders share with them to the president, vice president, and other important officers, and then they would be sharing the information with the employees of the company. But this is all part of how the company is being ran, and the decisions and the policies that are created are part of the corporate governance system. All right, continuing on with how corporations are organized, we can see that the ultimate control goes into the stockholders level. Stockholders are the owners of the company. We can have a majority share if there's more than 50% of the stock owned. When we talk about controlling votes, we're looking at 50% or more. So that doesn't mean that if you have less than 50% that you still don't have a strong percentage owned, but you're not going to make that majority decision. So stockholders have the ultimate control. As a stockholder, they typically meet at least 1 time a year, and they will discuss how the company is doing. If you don't attend the meeting as a stockholder, you still get an option to vote, which is part of the right of having a stock. But you can sign a proxy, which is giving a designated person the right to vote for you in your absence. All right, below the stockholders is the board of directors. So they are selected by a vote of the stockholders. So the stockholders decide who is going to be on the board of directors. They have the ultimate responsibility for managing the company. So there's the day-to-day operations, but those day-to-day operations and those president and vice presidents we see below have the responsibility of bringing that information to the board of directors. So we look at day-to-day direction. We have the president, secretary, the vice president of finance, vice president of production, vice president of marketing, and those are just some of them. You can see some companies have tons of vice presidents, but some companies may not have very many at all. Typically, we're looking at that president or the CEO or the chief executive officer. They're the ones that have the ultimate responsibility of the day-to-day corporate business transactions, and they're typically delegated to the executive officer positions and have been appointed by the board. Sometimes you can have someone that has the dual role of chairperson on the board of directors and CEO. In this case, they may have a president that's in the role of chief operating officer instead of CEO or chief executive officer. But when we look at the day-to-day, those are the ones that are making decisions about how the operations are going to run on a normal basis, and then they would deal with the employees that are operating the business below them. All right, so let's look at some of the basic rights of stockholders. So the first one we see is the right to vote. So a stockholder, every stock gets one vote, and this is typically for common stock. So if you're not there, you can sometimes vote by proxy. The other option you have the other right as a stockholder is that you have the right to sell your stock. So you're not required to keep it. You can buy it and sell it easily. And the next one is you have the right to purchase additional shares of stock. So for example, it's called a preemptive right. So if you owned 10% in a company and they decided to split their shares, then you were entitled to buy the number of shares that would still allow you to keep that 10% ownership. They can't decide for you that you're going to lose that percentage of ownership that you had before. The other right you have is to receive dividends. So if the company declares a dividend, then you're entitled to that dividend. We'll talk more about dividends later on. And then also if there's a liquidation, then after creditors are paid, you have the right to be paid in proportion to your stock ownership. Hopefully it doesn't come to that, but we do see it occasionally. All right. This is just an example of what a stock certificate might look like. So we can see that this is just one share of stock. It serves as the proof that you actually own the shares. If you were to sell that, you would sign the transfer endorsement that's on the back, and a new stock certificate would be issued to the next holder. But this just kind of shows us who the stock is for. It tells who bought the stock. It gives a stock number and things like that. All right, so let's look at the basics of capital stock. So when we're thinking about stock, the companies decide when they issue their charter how many shares they would like to be able to issue over the life of the stock. Or the life of the company, I'm sorry. So when we look at this, we can see that this company, for example, authorized in their charter that they could sell 250 million shares of stock. The par value is 1 cent, but it then shows how many were actually issued or sold, and then how many are outstanding. That means how many are actually out there in stockholders' hands at this point. So we're going to see those terms again. All right, so let's look at the other information. So we have a par value, which is the amount that's assigned to each share of stock when it's authorized. And then there's also a market price. The market price is how much that share of stock is selling for on the actual market. They are not the same thing. They are different. The par value is by the corporation. The market price is based off of market supply and demand. When we look at this, there are different classes of stock, and we'll go into more detail as we get into the next section. But the first one is par value. So that's par value, which is the amount that's assigned in the charter by the company. There's no restriction on the assigned par value. Some states might have a minimum legal capital that this corporation may have to have, so they may base the par value based on that. The other thing is no par value. So you can have a no par stock, which means that the stock has not been assigned a par value per share by the corporate charter. The advantage of that is it can be issued at any price without a minimum legal capital deficiency issue. The last one is stated value stock. So that means that there's not a par, but the directors assign a stated value per share. Stated value per share becomes that minimum legal capital per share in most cases where it's needed. All right, check out the next video for our next section, which goes into discussing in detail more of common stock.